Everyone's here.
Good afternoon, everyone. Welcome to Mindset Monday. Thank you to all of you who are always on time. Much appreciated. I'll be admitting the latecomers, but we're really excited to have a full update with our partners at Scotiabank today. I'm going to hand the stage over to Nicholas Geiser, who's also going to introduce his special guest. So go ahead, Nicholas. Thank you.
Yes, perfect. Thank you, Luis. Again, if you guys don't remember, I think we did one of these a couple months ago, back in the summertime. So again, I'm a mortgage specialist with Scotiabank. My manager is also here as well. His name is Sean Merritt. I've also brought along a special guest from Canada Guarantee, Casey. He's going to do a little bit of a PowerPoint on some of the new programs or government programs that have been announced with first-time home buyers and just default insured mortgages. So I'll pass that over to Casey shortly. I will sort of touch on sort of where we're at right now from I guess just from a quick market update, sort of what we're seeing from an interest rate perspective as well. And sort of how things are shaping up and sort of what our economists, I guess, are predicting for the real estate market moving forward. So I'll start first on sort of market update. We are seeing a little bit more activity, more pre-approvals coming in, so a little bit more people jumping into the market just with a little bit more optimism. Obviously, that rates are coming down. We're seeing a lot of first-time home buyers more intrigued by the new offerings that are coming out from the government. So there's some good activity there. From an interest rate perspective, we are seeing sort of the fixed rates sort of hold steady. We haven't seen a huge change from the fixed side of it. Again, the announcement last week or not last week, but the election results, I guess, in the U.S. Have played a little bit of a factor in sort of the interest rates and sort of where we're seeing those go. But we are seeing the fixed rates sort of hold steady. The variable rates, obviously, another announcement coming December 11th. So that should hopefully give us another rate drop and hopefully spark a little bit more into the market. We are sort of, again, economists in general, and especially Scotiabank economists, are sort of seeing that pickup start again sort of in the spring months. As we head into that spring lending, hopefully we'll see interest rates a little bit lower as well. We would have had at least two more announcements as well, one in January, one in March. So hopefully a little bit more optimism on that side of it as well. I'll pass it now over to Casey, who's going to sort of, he has a little bit of a slideshow in terms of the new programs, obviously with the default insured, and obviously some of the nice new improvements up to $1.5 million purchase price, 30-year amortizations. So all good things for a lot of first-time home buyers, which will hopefully allow them to get sort of into the market. So I'll pass it over to Casey, and then he can do his little thing at this point.
Awesome. Thanks, Nicholas. And thanks, Louise, for having me today. Some exciting changes coming up in the mortgage industry. And as we approach that election year next year, will be, maybe even more changes, right? They're coming at us pretty quick right now. And, they're good things, right? So nice to spark interest in the market. But as Nick is saying, we're seeing the exact same things at Canada Guarantee as well. Can everyone see my screen there?
Yeah.
Yeah, we're good. Okay, perfect. So my name is Casey Sienna. I'm the account executive for Canada Guarantee. So in Canada, there's three insurers. You might not know Canada Guarantee, but you've probably heard of CMHC Insurance. And then there's another one of Sagen as well. So we're one of the three insurers in Canada and work directly with Scotiabank there. So thanks for having me. Again, rule changes that are coming up effective December 15th. And there's another change that's coming up January 15th as well. So 2 dates on the calendar to kind of circle. So on September 24th, the federal government announced the expansion for all insured mortgages to help home ownership out. So obviously there's a home ownership crisis in Canada right now. So what they have done is the two changes are going to be that they're increasing that price cap on insured mortgages. So an insured mortgage is less than 20% down payment. They would have to get one of the default insurers to step up. Before, that was at maximum purchase price of $1 million. So you used to see those offers coming in at the $999, $999, and 99 cents just to get it insured. We've now upped that to $1.5 million. So now we can have a customer purchase a high ratio insurance mortgage, so less than 20% down at 1.4999,999 and 99 cents. So 1 penny under that $1.5 million. So really nice, as that has taken on a lot as prices have increased over the last couple of years. We've kind of been out of the insured space. We can't get, there's houses that are all over $1 million and we haven't been able to insure them, right? So all customers needed to have that 20% down payment, and 20% of, $1 million is $200,000 to have been saved in your bank account. So quite a bit of money. So a lot of people were going to bank of mom and dad to help them with the down payment to avoid that 20%. So it does open up the door for, having up that 5-10% down payment now. What we've also done is we're extending the eligibility for 30-year mortgages. So right now, the amortization, so how long it's going to take to pay off your mortgage, is what amortization is. It used to be 25 years, but we're now expanding it up to 30 years, and that's for all first-time home buyers. So all first-time home buyers buying either a resale or new construction on December 15th will be allowed to go up to that 30-year amortization. So what does this do? Is it obviously lowers the payment, allows them to qualify for a little bit more as well. So big changes to help those first-time home buyers out. And say you're not a first-time home buyer and you're wanting to buy a new construction, a new build, you're now able to do that as well with that 30-year amortization. So you don't have to be a first-time home buyer. You can just be sold a home, want to buy a new build. You can now do a 30-year amortization on that new construction. So really good news. Right now, there was a change August 15th where first-time home buyers buying a new construction could do 30-year AM. So that's effective right now today. But now it's opened the door for first-time home buyers buying resale at that 30-year amortization. So we're able to support these changes as of December 15th. So application comes to Nick at Scotiabank, sends it to us on December 15th. We'd be able to do those 30-year amortizations. Same with that $1.5 million purchase price as well. So just wanted to send this graph out, and this is purchases over $1 million, right? So that $1 million purchase price cap that was put in by the government was actually done in 2012. Okay, so 2012 is the first little blue box there. You can see, just say the Hamilton area. In 2012, 1% of home sales were in that over $1 million purchase price. Today, as of Q3 of 2024, we're at 25% of sales in Hamilton going over. And you can just see it throughout, Durham was 0 and now 31%. We've got the city of Toronto, obviously 10%. And now 47%. So that was long overdue to make that change of, the $1 million purchase price going up to $1.5 million. Like, it was put in 2012 when you can see purchase prices weren't over that $1 million mark. But now that they are, we were definitely due for that change. So increasing the price cap for insured mortgages up to the 1.5. So this applies to all applicants requiring high ratio insurance. So it doesn't matter if you're a first-time home buyer or a repeat buyer. Anyone can now buy an insured mortgage at that $1.5 million purchase price. So how does that work? So the down payment requirements on the loan are 5% of the first $500,000. So you need at least 5% on $500,000, and then 10% of the portion above $500,000 to $1.5 million. So if the purchase price was 1.5, it would be $25,000 on the first $500,000, and then 10% on the $1 million. So it would be a minimum down payment of $125,000. Just that's the way the math works. So if it was $1 million purchase price, it would be $25,000 on the first $500,000, and then 10% of 500 to $1 million, meaning another $50,000, so it would be a $75,000 down payment. So it's exactly the same tier as it's always been for the minimum down payments. So even though they've raised this cap to the $1.5 million purchase price, the down payment structure is the exact same. So what does this mean? Is that this is the purchase prices between that $1 million and that $1.5 million mark. So you can see it actually, we're going to be grabbing a lot of the, markets, right? So we've got 11% in Niagara that actually fall in that, 1 to 1.5. We've got Kitchener at 18%, Collingwood at 17%, Hamilton 19%, 25% in Durham, City of Toronto 23%, Peel 34%. Halton 32% and 36% in York there. So quite a bit of the sales are actually in that sweet spot, we like to call it, of that $1 to $1.5 million purchase price. So now instead of having that 20% down payment, your borrowers are now able to do it with the minimum down payment that I talked about. So expanding the eligibility for 30-year amortization. So this applies to all applicants who are requiring a high ratio insurance with a down payment of less than 20% that are either a first-time home buyer purchasing a new construction or existing home, or all other home buyers purchasing a newly constructed home. So kind of what I've discussed before. One of the nice things is what the definition of a first-time home buyer has been speculated about, right? And it's kind of the exact same as the RSP contribution. So the definition of a first-time home buyer is obviously the most simple is the borrower has never purchased a home before. They're considered a first-time home buyer. One of the most popular questions I get all the time is, what if it's two people buying a home? One's a first-time home buyer and one's not a first-time home buyer. It just requires one borrower to be a first-time home buyer to get that 30-year amortization. So at least one of the borrowers on the application has to be a first-time home buyer to get that 30-year amortization. Next, so if in the last 4 years, the borrower has not occupied a home as a principal residence that they either themselves or their current spouse common law has owned before. So say, I was in the market in 2020 and the prices went through the roof. I decided to sell my house and rent for the next 4 years. After those 4 years are up, I'm now considered a first-time home buyer again, even though I've owned a home previously. So another important thing is that if you've owned a home and it's been greater than 4 years, you're now considered a first-time home buyer again and are able to take advantage of this 30-year amortization. And the last one, and this is very new and a lot of people don't know about it, is that if the borrower recently experienced a breakdown of marriage or common law partnership. So say yourself and your spouse are living in a home, you decide to separate for some reason, and in Ontario it's about 40% of marriages, so there's a chance it happens. If you don't, within 90 days, you are now considered a first-time home buyer again after the date of your separation. So a marital breakdown, 90 days, you're now considered a first-time home buyer again once those 90 days have passed. The definition of a new construction property that has been sold within 1 year of the date of final occupancy, and the properties that developers, builders have as inventory when the final occupancy permit has been issued for more than 1 year are also considered a new construction. New construction properties must conform to the National Building Code and latest edition of the Resident Standards Canada of applicable municipal or provincial building codes, so have carry on warranty as well. So those are the definitions of a new construction and a first-time home buyer. So who these changes will impact on December 15th there. So occupancy. So when we're doing high ratio insurance, it's only for principal residences. So this is not eligible for rental properties. So if your borrower wants to live in one of the units and rent out, to say it's a duplex, that's fine. Just occupancy is only this high ratio insurance is only for your principal residence. It can't be a full-on rental. The effective date, like I said, is any application coming into us on December 15th. Another question was, what if they sign an offer to purchase on November 29th? Can they do this? All that has to be done is you would send it back to Nick on December 15th that they want a 30-year amortization, even though the offer was signed previously, as long as it hasn't closed yet. The closing dates in the past, December 15th, Nick can make that change and give your borrower that 30-year amortization again. So when we are doing, insurance, there is a premium that we charge as well. So the standard premium on a 5% down deal is 4% of the purchase price, and this premium gets added to the mortgage. So taking on a 30-year amortization is actually going to increase that premium, and it's a 20 basis points premium surcharge there. So instead of the 4%, it's going to be 4.2% there on the surcharge for the additional risk of taking on a 30-year amortization. So when 30 years, there used to be 40-year amortizations back in 2008, and they would have the same 0.2 surcharge. So nothing's really changed since increasing the amortization. Pawan, do you have a question?
Yeah, I was just understanding my clarity on premiums. Did you say the premiums are on the purchase price, or the premiums are on the mortgage extended?
The mortgage amount. It's added to the purchase. Yeah, added there. So if you buy something for $400,000, you put $100,000 down, it is now a 4% premium on $300,000 there.
Thank you.
So what does this do exactly? So the qualifying, so say you're having a 25-year mortgage right now and you buy at that cap price of just a penny or a dollar or 1 penny under $1.5 million. The down payment you would need is the exact same. Didn't matter if you took a 25 or a 30-year AM. The monthly payment would be different. So in 25 years, you'd be at $10,584. So you'd save about $500 a month. Going to a 30-year AM, the qualifying rate would be the exact same. You can see that that premium is a little bit different because of that 0.2% surcharge. So instead of $55,000 the premium would be $57,000, and the income that you would be required, instead of having $326,000 of household income to get that 25-year mortgage, you need $307,000. So again, it opens up that you might not need that income to get the higher mortgage amounts there. And just thought I'd put it to a more reasonable purchase price instead of the the 1.5 million to show just at a $600,000. The down payment again would be the exact same there of a minimum of $35,000. Your monthly payment instead of $4,500 would be $4,250. So your borrower would save $250. And the income required is going to be the biggest jump, right? So $8,000 less of household income is required to now buy that $600,000 home, as opposed to with the 25-year mortgage that you needed that additional $8,000. So it's good that it's opening up the market to people who might not have that income, maybe people who need to ask mom and dad to kind of go on title to make them qualify for them. So this is just a step in the right direction that the government's kind of doing to try to help home ownership out. Is it the best thing in the world, and is it the final answer of solving the crisis for home ownership? Probably not, but it is a step in the right direction to get homeowners, to get Canadians to become homeowners. So some of the frequently asked questions on this, and can applications be submitted requesting it prior to December 15th? So no, if you've got a file right now that doesn't close until after December 15th, that's fine. December 15th, we can make the change to that 30-year amortization for you, or that $1.5 million purchase price as well. But before that, unfortunately, there are no changes that can be made. For existing mortgage insurance applications, so like I said, this is the exact same. So if we have a file right now that your borrowers have bought a home and they've got that 25-year mortgage, they are able to resubmit. So Nick would be able to resubmit this file to us on December 15th, and we'd be on our way to giving the 30-year amortization there. The due diligence that's required. So again, what does Scotiabank need to make sure that the borrower does meet the requirement of the first-time home buyer on that 30-year amortization? So that's up to each bank individually, what they're going to need. Probably some document in your file saying that they are a first-time home buyer, and they can be verified with the solicitor as well. But we're not the police on the first-time home buyers there. And did they separate? Is it only 90 days that or 89 days that they separated, or is it the 90? We leave that up to the solicitor to do all of that, but it is based on that separation date, like I was saying, for that first-time home buyer. Will the increased purchase price apply to all products? So it is for all products that are on the market that we do offer. So just like I said, it's not on rental properties. It is on just principal residence, or if it's a duplex, triplex, or fourplex, your borrower has to occupy at least one of the units there to be able to go up to that 30-year amortization. And that's all the frequently asked questions. Another big change that kind of hit the market, we've got probably more questions than answers about it. Like, it basically came out, the government had talked to our CEO on a Saturday. On the month, can we do this? On the Monday, he answered back. On Wednesday, an announcement went out. So it is insured refinances are making a return. So right now, to do a refinance on your principal residence, you wouldn't be able to do it above that 80% loan to value. It would always have to be under that 80%. So you want to say you owe $400,000 on your home is worth $1 million. The max you would be able to take out back in the day would be 80% of $1 million. So it would be $800,000, giving you, that $400,000 of equity. Now, starting January 15th, they are allowing it for high ratio insured refinances where you can actually go up to 90% of the home value if you're constructing a secondary suite. So if you're so to solve kind of the home ownership issue is that, say you want to do a secondary suite in your home and you want that ability to rent a part of your home out, you are able to refinance and go up to 90% of the loan value. So like I said, in that example of $1 million, instead of only being able to take out 800,000, you'd now be able to take out 900,000. So giving you an additional $100,000 of equity there. So, and it is able to do up to that 30 years as well. The only issue with this is that the purchase or the value of the home cannot exceed $2 million after. So it's going to be a really tricky we see. So say your home's worth 1.7 million and you want to add a secondary suite. If when we do an appraisal, it bumps you over that $2 million, you're not able to refinance your home to do that secondary suite. So it does have a $2 million cap on the as complete value of your home, adding that secondary suite to your home. So another good, scenario for people who are looking for that additional income, looking to help, solve the housing crisis. Again, adding that rental component is very nice. Yes, Pawan.
Hi, I'm just thinking out loud and trying to understand if there's a cap on the amount that can be spent on that secondary suite. I mean, like, just for example, and being the devil's advocate, if somebody comes up with $500,000 spend on a secondary suite while they're technically not spending that same amount on the suite, and is there a cap on it? Like, how do we see that?
So we are going to require the quotes to cost to construct. So we would need the quotes of how much it's going to cost to add that secondary suite. We would allow up to the refinance just to cover the cost to construct. So no additional funds there. Does that answer your question?
I kind of expected that, but I'm just trying to understand if there's a cap on the number. So, for example, I mean, if somebody gives you a code which is 30% higher than the average cost to construct, like, is there a number cap on it?
No. So we would look at, is it reasonable? And the materials that are going to be used as well to do it, right? So obviously if it's, marble flooring throughout, it's going to cost a little bit more than, something like a laminate, right? But it's got to be reasonable. We've got to see some kind of reasonability on how much it's going to cost to construct a secondary unit. And again, one of the questions is the advance is only going to happen when the work's been complete. So if it is a $500,000 reno to get, the from point A to point B, how is your borrower going to carry that and get the work done without having any money, right? So I think that might solve some of the higher inflated values on that, is that the work needs to be done to get that advance to your borrower. So, how are no contractor is going to not work for anything and until the work's been done, right? So how are they going to carry that or, finish the job without having the money first?
Right, and which is where my question is, that is there going to be a check on the cap and versus what was committed and what was delivered? And I'm just trying to understand that.
I don't really I don't understand the question exactly.
I'll give you an example. For example, somebody turns up with a quote of 500,000 with marble flooring and, just like you said, high-end appliances and high-end finishes. And I'm assuming based on that quotation, this will be approved, and then advance will be paid out as work is being done. But if materials are changed through the process, that would bring down the cost, while more amount of mortgage would be funded.
Yeah, so there will be an inspection before the funds are released to make sure that the materials that were used were actually part of the quote as well. So if anything has been changed, we would be notified of the change, right? So say, they don't use marble and they use laminate, the appraiser goes to check on it and says, you didn't use what it is, the value wouldn't be supportive anymore, right? So.
Okay, thank you.
Awesome. Great questions.
I'm glad that's the case.
Yeah. That's a great question. So again, another big change is, to get that secondary suite, you can now use that 50% of the rental income to, service the deal as well. So, you get that rental income in your, to the the ability to increase your mortgage with that rental income as well. So, which is nice. So it would allow you to do these refinances as well there. So again, this is January 15th. So we've got the two changes, December 15th, with the first-time home buyers now being able to go up to 30-year amortization, as well as the increased purchase price of $1.5 million. And now January 15th, we've got the the insured refinance is making a return. So again, if we have an early election, which is some of the rumors, maybe we'll see some additional changes, but they're coming at us super quick. Like just to give some background on that $1.5 million purchase price. So our CEO and Sagen and CMHC had been fighting for years to get that increased, right? So we had been fighting nonstop with the government to say, that the $1 million was put in 2012. It is now, 2024. Prices are totally different. We were super close in 2021 to getting that change, but with the raising of interest rates, it would kind of defeat the purpose of them raising that cap, because it would fuel the market, and they were trying to soften the market by, raising interest rates. So at that time, we had been pressing for $1.25 million as the cap. We found out a week before the announcement that it was actually going to be raised 1.5, and our CEO didn't have to go to Ottawa to bang on the door to get the changes done. It was given to us at the $1.5 million purchase price. So it's nice. And, it's nice that the platforms for these elections do talk about housing, right? We're all in the market. It's nice to see that, right? Like I remember when 20 years ago, it wasn't an issue. Like you didn't know what each platform wanted to do for housing, mortgages, or anything like that. So it's really important these days to, see what each party is going to do to help the housing crisis that's happening here in Canada. So insured refinances. So these are some of the parameters of what must be done to get that insured $2 million or 90% of an insured. So you must own the property already is the one big thing. You can't buy it and do the work right away. You have to close the purchase and then do the refinance either right away after, but you must own the property or right before doing it. The borrower or close family member must occupy one of the units. So again, like I said, they have to occupy at least one. The other ones can be rented out. The borrower must intend to construct additional units, and the additional units must not be used as a short-term rental. So we're not looking to do these for someone who's going to be advertising for an Airbnb to rent that unit out. We're looking for long-term rental solutions here, not Airbnbs, to be popping up everywhere in the GTA or the GVA there as well. The secondary suite must be fully self-contained, so separate living facilities, kitchen, bathroom, etc., and comply with local zoning requirements there. So again, you would have to have your fire insurance on the secondary unit there. And it's a maximum of 4 units total, including the new unit. So what that means is you can do it so say your borrower has a triplex right now and wants to refinance up to 90% to add another unit to make it a fourplex. That's fine. We will allow that. Say right now it is a fourplex and they want to refinance. It's not eligible, as it would take it to the 5 units, and it's only a maximum of 4 units total that we would insure. So again, triplexes are the only ones, or the only ones, because that additional unit would make it a fourplex there, and it's a maximum of 4 units there total. Again, maximum 90% loan to value as improved property value, with the property value being capped at that $2 million maximum, and additional financing must not exceed project costs there. So again, it's not for additionals, wanting to pay out a car loan with this or anything. It is just for the cost to construct, to do the work on the secondary suites. And that's all I have. Does anyone have any questions?
That was amazing information. Thank you so much. Casey, I'm wondering if you would be able to share those slides. I think that certainly all of our agents and management team could definitely have those on hand as a great resource. Thank you.
Yeah, definitely. No problem. Yeah, I think it's, it's exciting time. There's not much that changes in the insured world. So to have these changes come up on December 15th and January 15th are huge. They're nice. It gets, people talking. Hopefully people back out on the market, like Nick said. So we've seen kind of the exact same thing Around here, as rates started to go down, we saw a little bump up, and then all of a sudden people just kept waiting to see if rates are going to keep going lower, right? And I think we still have those people waiting on the sidelines. So hopefully, we do see, like Nick was saying, that spring market is really what we're pushing for, to hopefully seeing some increased volume in transactions there. And I think this helps some people out. So.
Excellent. Any questions at all for Casey? Anyone? Just go ahead and raise your digital hand. Thank you, Colin, for all of your questions. All right. Thank you, Casey. Anything to add, Nicholas and Sean?
No, I think that's it. I think one thing that I will mention in terms of obviously that the refinance program that's coming out through Canada Guarantee is just reiteration on the Purchase Plus Improvement Program that's obviously also offered through all the insurance companies, but Canada Guarantee as well, where if you are looking to clients looking to purchase a property and do those renovations right away, in terms of putting in maybe a secondary unit or a multiple units, as long as one of them is occupied by them, Canada Guarantee and the insurance companies can also finance those. So another sort of added factor that the insurance companies do offer.
Awesome. Any questions? And Sean, thank you for joining us. Did you have anything to add? No. I don't think your audio is working, unfortunately.
I have a question.
Go ahead.
So my question is in regards to these secondary units. Are those units have to be approved by the city, and are those units supposed to be legal units?
They do not have to be legal. Sorry, go ahead, Casey.
It's a great question, and a lot of people are asking about it. Yeah. To get that legal would be a whole zoning thing being done after, and no, it doesn't, right? Those secondary units are just secondary units. We're not actually changing it to a duplex or a triplex there. It's just a secondary unit that's been self-contained.
So I'm assuming from the lender or from the lender's side, there is no restriction on it. Like, we don't have to provide them with the permits and whatnot.
No, there's no permits that are required. Just again, the quote is the most important part. As long as we have a quote, that's generally the most important aspect of it.
All right, fair enough.
Yeah.
Thank you.
Casey, I actually have a quick question for you as well on the secondary suite. Would that include garden suites as well?
Yes, it does. So, coach laneway homes in the GTA are obviously a big thing, and that would include that as well. So if someone wanted to do a coach laneway home for that secondary suite there, then this program does allow for that as well.
Perfect.
Any other questions, anyone? Great information. Thank you again to our partners at Scotiabank, Nicholas and Sean, and Casey. That was awesome. Great to meet you, and we appreciate your input today.
Perfect.
All right. We'll see you again, hopefully. All right.
Have a great day.
Thanks for joining us, everyone.
Thank you.
Thank you.
Thanks for joining. Bye for now.
Thank you.